Good morning, ladies and gentlemen, and welcome to the Premier MITON Global Renewables Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure that would be most appreciated by the company. And I would now like to hand you over to Head of Investment Trusts, Claire Long. Claire, good morning.
Good morning. Thank you, Jake. Good morning, everybody. I'm Claire Long, Head of Investment Trusts at Premier MITON, here with James Smith, who is the manager of the Premier MITON Global Renewables Trust. He's going to give us an update on what's been going on with the trust and his thoughts about the future. Just before we move on, there is an important risk slide that I need to pause on for you to read. And then let's move ahead with the presentation. So for those of you not familiar with the Trust, the Premier MITON Global Renewables Trust offers differentiated global renewables exposure. James will talk about that in a little while. It's aiming to provide investors with a high income and alongside that with long-term capital growth. And the shares are currently trading at a discount to their net asset value. So I'm now going to hand over to James to give us an overview of the global renewables market. James.
Oh, thank you, Claire. So thank you everyone from me for joining us this morning. It's been a pretty rough couple of years for the renewable sector. So in terms of share prices anyway, but quite a good couple of years fundamentally in terms of growth and profitability and all those good things. So there's been this, I guess, disconnect between performance and the actual underlying value generation and performance of the companies we invest in. So what I'd like to do this morning is just remind us why we invest in this sector and why we think it's a good sector to be in for the long term. And then we'll come on more to kind of recent performance perspectives and dig into perhaps why underlying moves have been as they have been and how we see that moving forward perhaps over the next 12 months. So first of all, I appreciate some of you who have seen these presentations before with us have seen this already, but I guess it doesn't, in the present circumstances, doesn't hurt to be reminded of some of the key reasons why we like this sector. So firstly, big picture, this is global renewable energy generation, so electricity generation from renewable energy sources over the past 10 years. And over that period, we don't have data for 2023 yet, apologies, this is from Bloomberg New Energy Finance, but that should come within a month or two. But over that period, we've seen a compound average growth rate, so an annual growth over time of 12.6% per year, roughly. And this isn't a number that is kind of being artificially generated through a low starting point. That growth has been fairly consistent. And in fact, if anything, if we look over the next few years, and we look at government targets and you know, whether they're met or not, but if we take those in mind, I would expect growth to be at least this level, or maybe even slightly higher. So if we look, for instance, at solar, you can see the pale blue bars there. Solar growth has been actually quite substantially ahead of that 12.6% over the past few years, as solar really has become very, very cost competitive. And likewise, I think offshore wind is about to go into a period of very substantial growth, particularly in the North Sea. So again, that may well grow quite substantially ahead of that. Now, why is it good? You know, fundamentally, why is it good to be in a high growth sector? Well, if the sector is growing, then there's obviously a requirement for capital to go into that sector to make those investments. And if there's a high demand for that capital, that tends to mean that not only is there a wide variety and a plethora of investment opportunities, but the investment returns on those opportunities are high, because you're in an expanding rather than a shrinking sector. And it's worth bearing in mind, we've got a lot of negativity around the sector at the moment, but when I speak to companies, and I do that, of course, all the time, the returns they are expecting to generate on new projects, even relative to, interest rates having gone up, but even relative to that, they're all very excited about the returns available in the renewable energy sector. So just moving on, let's take a look at the global electricity generation sector. So I think the first thing to understand is that if we take electricity as a percentage of the total energy that we use in the world, and you think about your own daily lives, how much electricity you use in comparison to other forms of energy, globally, it's only about 20%. So, you'll tend to use gas for your heating, or oil products, diesel or petrol for your car, and you tend only really to use electricity for maybe cooking or lighting your house. So that's something to understand. So electricity is about 20% of total global energy consumption. And if we look at the electricity sector itself, renewables are only about 17%. So that's excluding the large hydro. If we take small hydro, wind, solar, biomass, it's about 17. If you add in the large hydro, it's about 30, about 1/3. So I think you've gone too far there, Claire. Slide 6.
Oh, dear.
Sorry. Okay, so hopefully we're on the right slide now. So slide 5. So if you take those renewable bars there, that's about 17%, including the small hydro, or about 33.0%, including the large hydro. So, electricity as a whole over the world is still dominated by coal and gas and oil. Now, over time, with the growth in renewables, we'd expect coal and oil to and gas to gradually come off the system and renewables to grow. But the growth in renewables, that 12.6% per annum over the past 10 years, that's really come about through renewables expanding their market share in electricity generation. And if we take electricity demand as a whole, in fact, in the Western world, electricity demand has been on a slightly declining trend over the past 10, 15 years, maybe pretty level overall in the world, but certainly declining in Western markets, maybe expanding in emerging markets. But we'd expect to see that reverse over the next 10 to 15 years, and electricity to start growing, and there to be a higher demand for electricity as we use electricity for other things that we haven't previously used it for, such as transportation or manufacturing hydrogen, which at the moment is done from natural gas, or other industrial applications. So I'd expect to see that electricity share of total global energy usage go from 20. Well, if you take over to 2050, there's various estimations, but to achieve a sort of net zero scenario, you're looking more like 60 to 70% at least. So electricity will grow, and the renewables share within electricity should also grow. Now let's move on to the next slide, slide 6. And this is the total global energy market as defined by primary energy. So primary energy in its natural state. So of course, that is not electricity. Electricity only really exists in thunderstorms naturally, and it has to be manufactured. So if we just look at primary energy, where is the world getting its energy from? And again, it's very much dominated by fossil fuels, even more so, of course, than just looking at electricity in isolation. Renewables about 7.5%, plus hydro about another 7%. Now it's interesting actually, that's 7.5%, only about half of that is coming from renewables being used to generate electricity. The other half is largely biomass, and it's such things as ethanol production or the use of wood in emerging markets or biodiesel. So only about half of that 7.5% is renewables being used to actually make electricity. So if we take the total energy share in the entire world, only about 3 or 4% is renewable energy being used to generate electricity. Now, if we look at how primary energy generation has changed over the past few years, effectively, the global energy market has been growing by about 5% per year. Now, that growth has been entirely satisfied by renewables, which have grown by 75%, which is obviously a lot in a fairly short space of time. And oil, coal, gas have been maybe slightly increasing, but pretty much flat, really. And I expect that will be the trend that we'll see in future, that fossil fuels be on a flat to declining trend, and all the growth in global GDP, and of course, global GDP growth means growth in global energy demand overall, that will then be entirely satisfied by renewable energy. So let's take a look at what I like to call perception versus reality. Now, if you look at the sector's performance over the past couple of years, you would think that it's a sector in real trouble. And I think there is this disconnect between what I would actually see as happening on the ground and the way that many investors actually perceive things. So firstly, the big thing that's happened over the past 18 months, of course, is higher interest rates. And the perception is that because renewable energy tends to have a large component of debt within the capital mix. So if you build a wind farm, a large proportion of the cost of that wind farm is going to be funded by a bank. The perception is that if interest rates go up, your finance costs go up and your profit goes down. That's not really true, because pretty much all debt within the sector, or the vast majority of it, is long-term amortizing debt. So it gets paid off every year, but it's fixed rate, and that's the crucial thing. So I'm not expecting higher interest rates to lead to lower profitability for companies. And in fact, actually, in some ways, it has a benefit, because we've obviously seen the costs of actually building new renewable energy, particularly wind, going up. And a large part of that increase is higher finance costs. Now, if the cost of building new assets goes up, that tends to put, over time anyway, upward pressure on electricity prices. So if you have an existing wind farm, maybe let's say 10, 15 years old, and you've paid off the debt, you'll be rewarded over the long term with higher prices, simply because of a higher level of interest rates in the economy. But the second thing that I think is largely misunderstood is governments cooling on renewable energy build-out. So I don't really think that's true either. If we look at the actual direction of policy, in the States, of course, we've got the Inflation Reduction Act, which is working very well in incentivizing new electricity through various tax incentives. And they've put a price tag of, I think, 370 billion on that, but it might well be exceeded given the amount that's actually looking like it's going to be built. We've seen it in the UK. So you might have noticed, I think we had some questions on this last time, that last year the UK's auction for offshore renewables failed because they set the price cap too low. So they set it at £44 per megawatt hour. The government said that they're actually going to change that to £76 this year, so quite a large increase. And that just shows the UK government really is very keen to get more offshore wind built. I still view that as being a good long-term price and cost-effective for the taxpayer. But it certainly doesn't indicate a government that's going soft on renewables. And then lastly, the EU renewable law. So they want a 2 times increase in renewable energy to 2030, such that renewable energy forms 42% of their total energy use. So not just electricity, but total energy. And that's an increase from their previous policy was 32%. The current level is about 20%. So that really implies a doubling of renewable generation or renewable usage over the next 7 years.
Which I think maybe answers the first question we've had about how you're responding to the diverging government policies in Europe and the US towards the renewable energy sector. I think what you're saying there is you feel that there is still a lot of positive policy movements from all jurisdictions.
Yeah, I think the overall direction is very positive. I think Europe, over the past couple of years, has had a rather confused policy. So on the one hand, they've got various incentives, easing up planning restrictions, for instance, to try and encourage renewable build, but then they go and do something like the electricity generation levy, which I won't propose to go into details just now unless someone wants me to. So on the one hand, you're kind of putting extra taxes on it, and then you're also trying to incentivize it at the same time. So I think sometimes the policy is confused, but I think we're getting there in the end. The third one, power prices. Now, power prices are inherently volatile, of course, and we'll come on to this in some more detail later. Power prices were falling throughout last year, but from very, very high levels. And that's continued into the early part of 2024. And again, that's been very much seen as a negative for the sector. What I would say is that most renewable energy companies tend to fix their prices over the long term and only really have a relatively modest part of their revenues exposed to market, short-term market prices. We're seeing very strong demand for power purchase agreements, particularly in the US and Europe. So these are long-term contracts where large users of electricity will enter into a long-term contract directly with an electricity generator. Now, historically, they've been at a discount to market prices, but we're beginning now to see them actually being more toward market prices, and in some cases even above. So, for instance, I'll give you an example. So, in the States, there's a very high demand for data centers and new data centers, but of course, there's a very strong level of capacity constraint for electricity in America. So the technology companies, Amazon, whatever, if they want to build a new data center, they insist these days on having it powered with 100% renewable energy, and they are prepared to pay up to buy in that renewables and kind of skip the queue over other people that want renewable energy. And just on that, I see that there is a slight technicality here, but there's something called a renewable energy generation certificate of origin, or REGO, REGO, which you might hear talked about. So when a renewable company generates 1 megawatt hour of electricity, they get a little certificate to sort of guarantee where that power has come from. I guess it's like having traceability of your supply chain. And those actually can be traded separately to the power itself. Sometimes a power purchase agreement would bundle it together. But the value of those certificates has gone from almost nothing, they were pretty much worthless a few years ago, to now about £7 or £8 or euros per megawatt hour. And that's equal to about 10% of the power price. So these are quite big numbers. And that's happening just simply so corporates can guarantee and put into their emissions data that they can guarantee they are buying renewable power, and this is where it's coming from. I find that quite interesting. And then the last kind of perception is that capital costs of new renewables are increasing. Well, that is true for wind. We've seen the wind turbine manufacturers like Vestas or Siemens or GE having quite a difficult time over the past few years due to high competition, constant rolling out of new products, and they've started to, the margins have suffered. So as they're trying to build those margins back up to a more normal level, the price for turbines has gone up. However, solar has continued to fall. There's a glut of solar manufacturing capacity in the world, particularly in China. So we've seen solar costs, in terms of how much it costs to build, go from, in euros, for instance, 700,000, 800,000 pounds per megawatt. In Spain now, they can build at around 400,000, so a lot cheaper. And again, if power prices are falling, it doesn't really matter. If your capital costs have been chopped in half, then your returns are still very strong on new investment. So So that's a kind of quick run through of the global sector. We've got a short glossary there that you can come back to if there's any, or just ask me the question if there's anything you don't understand. Let's have a look specifically at the UK sector. So close to home, what's been going on in Great Britain. So in terms of electricity pricing, we've had this really, really volatile period. And I've got kind of two blue highlighted periods there. So pre-Ukraine, so up to, I know Ukraine happened in, I think it was February 22, if I'm not mistaken. Power prices had started going up before that, maybe perhaps in anticipation. But we've gone from this period of relative stability. So you can actually see quite easily with the naked eye the left-hand side of this power price chart. So these are UK wholesale electricity prices. Fairly low volatility and an average price of about £53 per megawatt hour. And then we had this crazy period over most of 2022 and toward the end of 2020 or mid 2023, where we've had very, very high volatility as Europe has kind of weaned itself off Russian gas. And of course, that was very painful for a lot of people, but huge swings in electricity prices. And now we've gone into this period whereby prices are higher than they have been, but they're lower than they have been over the past few years. But we've got higher volatility, and that's the right-hand side chart. Now, to bring this graph up to date, prices so far in 2024 really have been very weak. And in the UK, we've seen them come back down to more like £60 per megawatt hour. So still slightly above where they were in the distant past. But I view this as quite temporary, really, because if we look at the gas market, and it's worth remembering that the price of natural gas tends to set the price of electricity. And I can show you a price of UK wholesale gas, and it looks pretty much exactly the same as this one here for electricity. There's a glut of LNG at the moment. We've had a very mild winter in the States. At the same time, they've brought on a lot more LNG capacity and a lot more shale capacity. Now, gas in the States is currently trading around $1.6 per MMBTU. And without worrying too much about what that means, it tends in the past to be about $3 or above, $3 to $4. And if you asked a shale company what price you need to justify drilling a new well, they would tend to be $3 or above. So I think that's probably quite a temporary price. It can't continue at that level because no one will drill any more gas. So as soon as that goes back up to around the $3 level, I think we'll see electricity prices go back up more toward that £100 per megawatt hour. So we've seen a lot of weakness in the UK renewable sector because prices have come off so much. You see, I just stress, I really do see that as a temporary phenomenon. If we just turn to the underlying drivers of the power price. So, and again, looking at what happened last year compared to sort of pre-Ukraine levels. So we've seen this huge increase in gas prices. Currently, UK gas prices are, we price it in therms in the UK rather than MMBTU. I wouldn't worry too much. I mean, you can look up on the internet if you want to figure out how to convert them. It's currently about 57p per therm. So you can see it's a lot less than it was throughout last year as an average, but still quite substantially higher than 2020. And the other thing that's been going down recently are carbon prices. Now, because gas sets the price of electricity, it's gas power stations that set the price of electricity rather. They have to pay for carbon emission permits when they generate. And that can form about, well, for instance, each megawatt hour of power will probably generate from gas about a third of a ton of CO2. So they probably have roughly a carbon cost of about £20 per megawatt hour on a 60 or 70 price of electricity, for instance. So it's about a third. If you're running a gas-fired power station, carbon prices are about a third of your operating costs. So quite significant. And we've seen those swing around a bit. They're currently a bit lower, but I expect again they'll go up because governments want them to go up. and if they see them too low, they will start withdrawing permits in order to get the CO2 price that they want. And again, lastly, interest rates. And again, that does have a knock-on effect into the power price, particularly for new generation assets. If you're going to build a new gas-fired power station, for instance, or a new renewable asset, a new wind farm, that interest rate is really a key part of your overall cost dynamic. So UK power generation, if we just turn the next slide, thank you, Claire. So where are we compared to the global position? Well, quite a lot better if we look at our renewables. Now, in the UK, we're still reliant on gas for about 40% of total power, and nuclear about 15%. But wind, you can see there, 25%, and solar about 4%, but that's growing very fast. I've just written an article actually, which is available on Premier's website, where we talk about volatility of renewables and solar and wind and how we expect those to move going forward. And I'd recommend you dig that out. But solar really is going up from this 4% level. Renewables now, so they're almost half of our total electricity generation. And where are they going to get to? Well, I wouldn't be surprised to see us at 75% by the mid-2030s. I think the government wants a totally decarbonised electricity system by 2035. So you can see that there's still going to have to be substantial growth in the UK in order to achieve that. Okay, so now let's look at some, I think, really interesting stuff, some performance perspectives on the trust and the sector. So we don't really, the investment trust doesn't really bear much relation to the S&P Clean Energy Index, but that's kind of the closest thing really if you want to pick a performance benchmark comparator. And what we're doing here, we're plotting the price of the index, and that's on the left-hand side in US dollars, to the movement in 10-year US Treasury yields, and that's on the right-hand scale. And you'd expect those things to show correlation if you inverse the Treasuries. So as interest rates go up, you would expect the index to go down, because people often see this sector as a bit of a bond proxy. And what I mean by that is they see the revenues in renewable energy as being fairly fixed in nature, or bond-like, and therefore if interest rates go up, you discount those back at a higher rate, and you end up with a lower share price. There's various reasons why I don't think that's correct over the long term, because, for instance, the sector's growing, whereas you don't get any capital growth if you own a bond, of course. But we've seen that rather break down of late. So there was high correlation throughout most of last year, but we've then seen yields fall, so that black line going up, but the sector hasn't rebounded in the way that I would have expected it to. So I think that's quite interesting. The sector, just looking at this anyway, looks a little oversold to me. And then if we move on to looking at a couple of specific examples. So here, this is the largest holding in the trust at the moment, Greencoat UK Wind. So this is a UK renewable energy investment company. Owns a mixture. It's all wind pretty much, but it owns a mixture of both onshore and offshore. And what we're doing here, we're plotting the share price against the 10-year gilt yield. And again, you've seen very high correlation between the two. So what the market is doing, it's effectively saying that this company is really just a bond. And it's been trading it as though it were a bond. And it's ignoring the fact that actually it's growing, that it's generating cash well in excess of its dividend, and that cash is being reinvested into new assets. It ignores the fact that a large part of its revenues are index linked. And of course, interest rates are only high because we've had more inflation. And they get the benefit of that inflation because their revenues go up and their costs don't. So, these companies really do love a bit of inflation. Of course, if you own a 10-year gilt, if inflation goes up, that's a negative to you, whereas for the company, it's certainly a positive. So again, that doesn't seem to make any sense that it's trading in that way, but that's the way the market looks at it, and I think therein lies the opportunity. Just sticking with Greencoat, if we look at its NAV per share and compare it to its share price, you've seen in the past that this company, along with similar companies in the sector, has tended to trade at a premium to its NAV per share. And the reason it would do that is that if you look at the underlying calculation within that NAV, it's very, very conservative. They would tend to look at all the assumptions and take the most pessimistic case that they really believe they will outperform, and they will use that pessimistic case to calculate their NAV. Therefore, the share price should naturally be quite higher. And of course, the companies like it that way, because if the NAV is below the share price, that means they can issue new shares. However, over the past 12 to 18 months, you can see that the shares are now at a discount to the NAV. And in fact, with interest rates having gone up, you can see that it hasn't really made that much difference to the NAV. So even though the company has been increasing those interest rate assumptions within the NAV, other factors, such as inflation, for instance, have offset it. So, yeah, there's a lot of pessimism built into the NAV, and even more pessimism built into the share prices. And if we look at an average sort of discount across the sector of these UK renewable energy investment companies, some of them are trading on about 30% discount at the moment. If you take Next Energy Solar, for instance, Greencoat's a bit less, I think that's about 15 at the moment, but an average for the sector of about 20 to 25%. So good value, I think. Okay, so those are some performance perspectives. Let's take a quick look at, we'll just run through this quite fast in the interest of timing, but a quick look at what the trust is actually investing in, just to remind everyone. So we segment the portfolio into various ways, but the two key ones there, the 41% and 32%, are the core renewable energy companies. And there are basically two flavors of these. So the renewable energy investment companies, and these are stocks like Greencoat, and their business model is to buy ready-made assets, usually newly constructed, and then they will run them and operate them and pay out the cash flows over the life of that asset. If they want to buy new assets, they have two routes. Either they retain a bit of cash over and above their dividend, or they issue more shares. It's quite difficult for them to do the latter at the moment. So the growth in the sector may be a little less than it has been in the past, because of course they can't issue shares with the share price being below the NAVs. But we tend to hold those for really to get more income and slightly less on the growth. The other category of core renewable energy companies are renewable energy developers. And these are the companies that actually develop a project from first inception. So, going through the planning process, the permitting process, the environmental process, looking at the wind studies, dealing with landowners, etc. And that can take quite a while, but is more capital intensive. It takes a long time. So they would tend to pay out less of their earnings as dividend and would tend to grow using more retained earnings. So we would tend to own those more for growth and less for yield. And then the other, just over 25%, is kind of everything else. So it's a mixture of renewable focused utilities. A good example would be SSE, for instance. So those utilities that are very strong renewable businesses. Biomass, that's mainly Drax Power, and then energy storage, which we may come on to later. That's mainly the battery companies in the UK. And then other things that are essential for the safe delivery and growth of the renewable energy sector, such as networks, renewable technology and service, for instance. So we have an investment in a company which owns vessels which construct offshore wind farms. So that would fit into that category, for instance. Now, one new thing that we've done in response to requests from investors is we've actually segmented the portfolio also by technology. Now, this is actually quite a big sum, and it's not that easy to do because a number of the companies we own will have both solar, they'll have wind, offshore wind, Some of them may have some gas plants still, if, like, take for instance RWE or SSE, for instance. So the question is, how do you split? How do you actually make this segmental analysis? So, and it all depends really what's been disclosed by the company. So ideally, we would do it by profitability. So that, I think, gives you the best underlying method of segmentation. But however you do it, you can see that the trust has quite a large mix of technologies. Solar is the largest, then onshore and offshore wind. I guess if you take onshore and offshore wind together, it's similar to solar. But yeah, a really good mix of technologies there. And this is what we're trying to do. This trust really is a one-stop shop for those people who wish to take a global exposure to multiple renewable energy technologies. It's worth just reiterating the fact that this, at heart, is an infrastructure portfolio. So we don't own things like Vestas wind systems. We don't own the solar manufacturers or anything like that. We just want the companies that are building, owning, and operating those infrastructure, renewable energy generation or network type assets. And that gives you that long-term visibility and good long-term returns. Moving on to geographic, there's not been any real change over the past 12 months to update you. So UK is still the largest, together with Europe. Global, so a number of companies we own operate around the world, and there is no one dominant country that they invest in or region. So we would tend to put those into global. So stocks like Northland Power, for instance, which is primarily an offshore wind business. So it owns 3 wind farms in the North Sea, about to start building one off Poland in the Baltic Sea, about to start building one off Taiwan, owns a number of onshore US renewable assets. So again, it's quite difficult to segment that into one individual place. So we just put it into global. North America is quite light. The reason, it's not that we don't like North America. The way that renewable power is sold in North America, it tends to be on very long-term fixed price contracts. It doesn't mean flat price, but they would tend to have price escalators in at maybe 1 or 2%. But what they don't do is have a direct inflation pass-through. So we've been quite light in the US because we knew the market would treat those things really as bond proxies in the way they traded them, and that's turned out to be the case. So North American renewables have kind of underperformed, and this is one reason. If we look at our total assets performance of the portfolio and compare it to the index, we have done quite a bit better over the past 12 months, and that's one reason, because we've been a bit lighter in North America.
And there's just a question there about China, James. That used to be a larger part of the portfolio. Investors saying, why is that not so much of interest now?
There's a couple of things. I mean, China is the world's largest energy market, and certainly the world's largest renewables market, and has experienced very high growth. But that hasn't necessarily translated into earnings as much as we would have liked. So the companies we have owned have done very well top line, but their profitability has lagged a little where I would have liked to have seen it. So that's one thing. And then, of course, the other thing that we just can't escape is that, the Russian invasion of Ukraine kind of changed everything. And if you owned Russian shares, you have lost everything. It's not like you've lost 20%. That investment has gone to money heaven. And if, as they say, if China does something in Taiwan, we aren't getting our money back from anything in China. So I wouldn't be comfortable until we have more visibility on that whole political situation. At one point we had over 20% of the trust in China. I think that would be very ill-advisable at the moment. I can't predict what's going to happen. I would be surprised if China were to invade Taiwan, but the returns on offer to us simply aren't high enough at the moment to justify taking that risk. Okay, so what we've got now, just a couple of new slides actually. So a couple of case study here. This one is about a Spanish stock, Spanish listed company called Renewable. And this is a developer, so it sits in our renewable energy developer segment. and it's primarily a solar business. But the big thing it's doing, the reason I find it interesting, is it's about to build the world's largest solar and storage hybrid project in Chile. So Chile has very, very strong, probably the best in the world actually, solar resource. It's the world's best. It really is fantastic, particularly in the north in the Atacama Desert. But the problem is that because of a lack of storage, power prices are very low in the day and very high at night. So Grenergy is building I think it's huge, it's almost 5 gigawatts of new solar, but they've actually been able to sign peak power contracts on that because they're also backing it almost 100% with electricity storage. And so they've already got a lot of these contracts in advance to actually sell the power at very good prices, and now they just have to build it. And this is why, as that asset starts to come online from 2025, you can see a big drop in its earnings multiple, and that will continue even more so in 2026 and 2027. Net income is a bit lumpy because it's a developer. The business model is occasionally to sell a stake in an existing asset, a revenue-generating asset, or in fact sell an entire solar farm. So I think over the last year they've sold 4 solar farms in Spain that they've built, and they've just sold one in Peru actually. And if you look at the price that they've been selling those assets at, it's been about twice what it's cost them to build. So in Spain, for instance, they've been selling solar farms on about 1 million euros per megawatt of capacity, and their build cost has been about 500,000. So that is really fantastic business, and that the profits that then generates is then used to go into the next asset. In this case, this huge solar farm they're building in the Atacama Desert. So again, quite an exciting company, I think. And if you look a couple of years out on very, very reasonable valuation multiples, and you look at the return on equity, it's very, very strong. So that's Grenergy. Let's skip a couple. Actually, we've got some more details. If you just move on more forward from that, some more details on that here. So I'll let you look at those at your leisure. And then the next case study, if we look at a company, RWE, which I'm sure most of you will have heard of, and this really just illustrates, I think, how the market really does have a major downer on the sector. So RWE has what we call a capital markets day, so an event every 2 years for investors, for professional investors. And in it, in those events, they put out various targets, and we can see how those targets have moved between their investor day that they had in November 2021 and the one they held a few months back in November 2023. So let's just look at these in turn. So in each of those, they gave net income guidance for 2027. And in 2021, they were expecting to make 1.2 billion euros of net earnings by 2027. November last year, that had gone to 2.3 billion, so almost double. Likewise, if we look at EBITDA, so EBITDA, of course, earnings before interest, tax, depreciation, amortization, so a kind of measure of gross profits before you deduct non-cash asset depreciation. Their 2027 target has gone from 4 to 6.7 billion. And for their 2030 guidance, it's almost doubled from 5 to 9 billion. And what's going on there? It's a combination both of higher returns available to the company and simply higher growth. They're going to build more assets than they expected they would build because the demand is simply there. Governments are offering incentives and helping with planning and permitting, etc., etc. Now, if we look at the way the market capitalization has moved between December 21, so roughly the time of the last of the 2021 Capital Markets Day, and where it was at the end of January, the market capitalization has only gone up by 5%. And in fact, they issued a few shares in order to buy an American company. The share price has actually fallen slightly. So effectively, the company is saying by 2030, we're going to be twice as big as we thought we would be, and the market hasn't moved. So the growth that the companies are accessing is simply not being captured really into share prices. So again, I just think it's interesting how the sector really is so out of favour, and I guess therein lies the opportunity. So that brings the formal presentation to an end, but we've got time to take any questions at all that anyone has.
Perfect. James, Claire, for me. If I may just jump back in there, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Claire, James, as you can see there in the Q&A tab, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But Claire, if I may now just hand over to you just to chair the questions with James. And if I could just ask you just to read those out and give your responses where it's appropriate to do so. And then I'll pick up from you at the end. Thank you.
Thank you. Okay, so there's a question. You talked about rising costs for new projects in the current environment. James, what criteria do you use to evaluate the attractiveness of new returns and to ensure competitive returns?
So the way to look at returns, I believe, is to look at them on a relative basis versus the risk-free rate. So the return you would want to build a new renewable energy asset is obviously going to be different in this 4% interest rate environment, looking at 10-year government debt, compared to when it was, 1% or 0.5%. So that additional increase of 3% per year in the risk-free rate has to be taken account of in the returns you want to build a new renewable energy asset. And now, if we look at the sort of implied returns on the existing asset base of these companies, so if you take, say, for instance, the UK renewable energy investment companies, and if you look at what they are trading on as a potential return based on the current share price, the spread, the available return to you compared to the risk-free rate has actually gone up over the past couple of years. So returns available to a new investor in the sector now are higher. If you look at new assets, which the question relates to, companies are very careful now to make sure they don't destroy value. And we've seen companies cancelling projects, like Ørsted quite famously, which we don't own in the trust. Again, we can come on to that if anyone's interested. So Ørsted, of course, cancelled, the world's largest offshore wind farm company, cancelled a number of projects in the States. We've had a few cancellations in Europe, in the North Sea. So if companies aren't meeting those return objectives, they will not invest. Now, talking to the companies that we own, if anything, the returns available are actually higher. So even though costs have gone up, interest rates have gone up, in reality, the returns that they're expecting to make over and above risk-free rates have actually improved slightly. And that's a function of the huge upcoming growth in the sector and this general shortage of capital. So for instance, to give an example, last year, the government, the UK government this is, had their AR5, auction round 5, for new renewable energy assets, where the government awards 15-year index-linked kind of fixed pricing. Now, the government set the maximum bid price for offshore wind too low. They set it at, I think it was £44 per megawatt hour. And they didn't get any bidders. So no one bid, and it was a complete failure. So they've now had to increase that for the upcoming auction later, well, actually it starts in a few months, to £76 per megawatt hour. So quite a big increase. And that should be enough then to get investors' interest again. So, I'm not too worried about new returns. I think at that price level, I expect the auction will come in at a slight discount, but the returns on that, for instance, should be good. So we're seeing in Europe and also in the States, where it tends to be more commercially driven, if the price offered isn't good enough, the asset won't be built.
Okay, thank you, James. And there's a question there now about the sustainability of the Trust's dividend growth strategy in the context of current economic environment.
So the dividend growth, there isn't really a dividend growth strategy per se. I mean, the official investment objective, Claire, I think, is just to pay a high income with potential for capital growth. So we don't guarantee that the dividend will be increased. Now, last year, we've been paying out interims per quarter at 1.75p. So that's a dividend of 7.4, isn't it?
Yes, that's right.
Now, the earnings last year, so in the actual revenue earnings of the trust, less the operating costs like management fees and board, et cetera, and auditing, came in at about 8.1p. So there's quite a bit of headroom there to pay out a slightly higher dividend should the board want to. But the board are quite conservative in the sense that we only pay out a dividend to the extent that we have income within the trust paid from the portfolio. We won't pay anything more than that. But income growth over the past couple of years has been quite good. So you'll see our income going up, and that's translated into a slightly higher dividend, going from 7p for 2022 to 7.4p in all likelihood for 2023. I just say all likelihood because the final dividend hasn't yet been declared, but assuming it's unchanged, that will be 7.4p. And again, that's comfortable for the trust. That is not having to pay out retained earnings. It's not paying out more than we're actually receiving. In fact, there's quite a bit of headroom over and above that.
Okay, then a question about the capital structure. How do higher interest rates impact on the trust's own capital structure?
So the interest rates don't make any difference to the capital structure itself. Okay, so the capital structure of the trust is slightly complicated in the fact that it's a split capital investment trust. So we have two classes of share. It sounds horrendous, but actually it's not actually that difficult in practice. So the first class of share is the zero dividend preference share, and that's an instrument not quite so common as they used to be, but we issued that in November 2020, and it gets repaid at the end of 2025 or November 25 at £1.27, just slightly over, actually, just 0.16, I think, 127.16. And if you work that out, that's 5% return per year if you'd bought those ZDPs when we issued them in 2020. Now, our finance costs are therefore fixed until November 2025. Of course, interest rates have had an impact on the valuation of the portfolio, as they have for many other sectors, such as property or utilities, for instance. And I think investors have been over-focused on that. And as we've seen through those slides earlier, I think the impact has been greater than perhaps I'd have expected it to be. But as far as the capital structure is itself concerned, there's no impact.
Okay, and then just another question in terms of structure. Is the size of your trust an issue for its performance and the discount to NAV?
The size of the trust shouldn't be an impact on performance so much. I mean, I guess it's fair to say that the smaller the trust, the higher the operating costs as a percentage of total assets would be. But again, our operating costs are about, I think it's about 1.6, 1.7 if you look in the annual report. So looking at management fees, audit, board, secretarial, custody, all that stuff. So that's quite high, and that is a function of it being a smaller trust. And of course, we'd like the trust to be bigger and that number to be lower. But even if we were 5 times as big, it wouldn't be much below 1%. So that would be, we've probably got an additional cost, I would guess, somewhere between around about 0.5% or 1% maybe through being small. And that obviously that's not great. And there's not a great deal we can do about it at the moment. In terms of discount to NAV, if we take similar trusts such as Ecofin, for example, Now, Ecofin is quite a bit bigger. It's more like 200 million. It obviously invests in utilities rather than renewables per se. But Ecofin's discount's 20%. So we're a bit tighter than that. And we're, traditionally a split capital investment trust would tend to have a higher discount than a vanilla investment trust. So our discount compared to peers, I think, is, it's not out of line.
Okay, and just one final question. In terms of sort of peripheral areas that are looking interesting, and perhaps particularly batteries, which haven't done so well recently, are they still worth investing in your view?
So you might have seen that if any of you own some of these battery storage funds like Gore Street Storage or Gresham House or Harmony Energy, we own a few within the trust, because I've actually recently written an article about storage, which again I recommend you take a look at. So if you have a large renewable sector within your electricity generation sector, you do need a way to kind of manage that intermittency. And the more renewables you have, by and large, the more volatility there will be on the system. And that's a good environment to own a battery, because when prices are low, if there's too much renewables or too little demand, you can take in the power quite cheap and then sell it a few hours later for quite a bit more than perhaps you paid for it. But that system is run through the National Grid's balancing market. So that's a system organised by National Grid, where the National Grid traders try and manage those fluctuations in demand and supply. Now, historically, that's been a very manual process, with the balancing market traders simply calling a gas-fired power station and asking them to dial up their load and put some more power into the grid. They're changing that so that, because it's a requirement that they make that system compatible with a clean energy or carbon-free electricity market. And to do that, they have to use the batteries. So they've had to build a more algorithmic trading system that will allow those batteries to access that market. And that's been going slower than we've anticipated. So we are assured that it will be a lot better within the next 6 months. But until then, I think batteries are having a tough time. But long term, I think the outlook is exceptionally good for UK battery storage.
Okay, James, thank you very much. I will hand back to Jake now.
Perfect. James, Claire, thank you very much indeed for being so generous of your time then, addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we will make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But James, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Okay, thanks, Jake. Well, I'd like to thank you all again for joining us. If you have any questions, do feel free to be in contact with us on the contact details available there. We would have liked performance to be better, but if I look at the valuations within the trust and the underlying performance, which again I think is reflected in the income we receive into the trust from dividends that the companies pay to us, things aren't going too badly at all, actually. So I would encourage people to stick with the sector. I really would.
James, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Premier MITON Global Renewables Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.